To watch these important lessons, subscribe to DP Education's YouTube channel right now. Click on the bell icon to stay updated on the latest lessons. Sri Lanka's largest free online school, DP Education.
Hello children, we have another chapter in the 2022, 23 paper. That is the latest paper. We started this paper in the previous video. This is the second video, right? So here we are, 2023, 2022, right? 2022. OL first paper, paper 1, which was done in 2023. 2023, which was done in 2023. So this comes as 22, 23. First paper. From the 17th question. Here we go. Now, guys, now you know that the first 16 questions are from business studies. From 17 onwards, it's accounting, right? So business studies part is done. First 16 questions. Now counting. The double entry, the basic, the most fundamental, the most primary, easiest things come first. Double entry principle of increase debit and decrease credit is relevant to. Double entry principle, increase debit, which means increase should be like this. Increase and decrease, right? So increase debit, decrease credit. That is the double entry principle of what? Increase debit, decrease credit. Assets, of course, increase debit. When assets increase, you put that increasing asset, increasing value to the debit side of that asset. Ledgers, double entry ledgers. Increasing debit. When an asset decreases, it goes to the credit, right? Increase debit, decrease credit. So asset is okay. Expense is also okay, right? Because increase are debited and decrease are credited. Then we have assets and expenses. So obviously this is the answer. Both are increase debit, decrease credit. Here we go. Both are increase debit, decrease credit. That is the principle, double entry principle, right? Next, a transaction that affects to change the equity of the accounting equation of a business. What is the transaction that affects to change equity? That means increase or decrease equity. What is the transaction? Purchasing a stock of goods of 5,000 on credit. Purchasing, we are buying goods to the business. So goods come into the business. That is an asset, right? That is an asset. That is A for assets. Goods bought. So assets increase. But 5,000 goods bought on credit. That means we don't pay for that stock, which means on the other hand liability also increases. No equity. Transaction that affects equity, paying the electricity bill of the business. Well, paying the electricity bill, nothing comes into the business, nothing flows, nothing increases in the business. Electricity bill, it's an expense. So cash goes out, cash is paid, right? Cash is paid, cash goes out, cash decreases. Cash decreases means asset, it's an asset, so asset decreases. At the same time, liability, no, there's no change in liability, equity decreases. That affects equity. Paying the electricity bill, 12,000. You know what? There are two main events or two transactions which can increase equity, and two transactions which can decrease equity. Events or transactions, you can call whatever. Items. Two items are there. Those two items increase equity. Okay. And two other transactions or events are there. Those two transactions decrease equity. What increases equity? Incomes or profits and what? No. Sales do not increase equity. No. Additional capital, that is the other one. Profits increase equity, or incomes increase equity. We say profits increase equity. Additional capital also increases equity. On the other hand, guys, losses and expenses decrease. Losses and expenses decrease equity. So this is an expense. Paying the electricity bill is an expense. Effects to change equity. Next question. Rahul sold the stock of goods which cost. Read it. Did you read it? What is the answer? You tell me. You tell me. Okay. Tell me what the question is asking you. What is it asking you? First, you have to learn to read and understand the question. Right? I'm not going to be there with your paper when you get the paper at your O-level examination. No, I don't think I can be there with you. Okay, read and understand the question. That is the first one. That is the first thing. Rahul sold stock of goods which costing 7,000 at 10,000 in cash. For cash. Rahul sold a stock of goods. He sold a stock of goods, right? A stock to a customer and got cash into the business. Goods were 7,000 but sold for 10,000. What is the profit here? 3,000. Through this transaction, the amount of total assets of his business increased by 3,000, decreased by 7,000, increases by 10,000. Does not change. Easy question, right? He sold goods worth of 7,000. So under the accounting equation, goods go down. Goods is an asset, so goods decrease. Goods decrease, or you can write stock decrease. How much? 7,000. That is this 7,000. Then 10,000 is coming into the business, so cash comes into the business. Cash increases 10,000. What is the net effect? Final effect of this change. 7,000 goes down, 10,000 goes up. So the net effect is 3000. Net effect means the final outcome of the two transactions. 7,000 it decreases, again 10,000 increases. That means the difference is 3,000 increasement of assets, increases by 3,000. Next up is 20. The accounting equation of Ryan's business is given below. We have assets 150,000. We have equity 100,000 plus 50,000 of liabilities. Here we go. Equity plus liabilities 100,000 plus 50,000, 150,000. After a transaction, the values of this accounting equation was not changed. What is that transaction? Okay. Values of this accounting equation was not changed. Wow, values did not change. What a surprise. I don't know. Do you know? After, it's easy, right? When the transaction happened, values did not change, means the 150 of assets remained as it is. The 100,000 under equity remained as it is, and the 50,000 of liabilities remained as it is. How can this happen? It can happen. It can happen. Let's see. Paying 7,500 to a creditor. Paying 7,500. Cash goes out. So 7,500 decreases from assets because cash goes out. Paying 7,500 to a creditor means liabilities. Liability 2 decreases. So it changes these values. That transaction, this transaction changes the values, of course. Next, receiving 10,000 from a debtor. Receiving 10,000 from a debtor. Let's see that. Receiving means we are getting cash. We are getting cash coming into the business, right? Cash coming into the business. We have cash now, and more cash came in. So that increases the assets by how much? Receiving 10,000. Increased by 10,000. From a debtor, no. Debtor is an asset. Debtor is also an asset to the business. Yeah, debtor's assets, right? Asset. That asset. Now, he's no more there. He's not in the business anymore. I mean, he's not a debtor anymore. So that asset decreases. Debtor asset decreases by 10,000, right? Debtor, when he comes and pays his debt and leaves, he's no more a debtor. Receiving 10,000 from a debtor. So 10,000 increase, 10,000 decrease, 10,000 increase, 10,000 decrease. There is no effect to this value. There is no effect to this value, right? No effect to this value, no effect to this value. That's what our answer should be. The values of this accounting equation was not changed. So this one. Receiving 10,000 from a debtor. Let's look at the other one. Receiving a commission income of 15,000. Commission income. Money coming in as income. That increases assets and that increases equity too. So both values change. Purchasing furniture of 100,000 for office use on credit. Furniture means asset. Asset increased by 100,000 on credit. So liability also increased by 100,000. Second is the answer, definitely. 21. Decreases both assets and liabilities. Which transaction decreased both assets and liabilities in a business? Assets should change and liabilities too should change. Now, what can be that transaction? What can be that transaction? Owner gets rupees 10,000 from the business for personal use. I can't say. Owner gets 10,000 from the business for his personal use. 10,000 cash goes down, equity also goes down, right? Yeah, what are we going to do? We are going to draw our accounting equation. Equity plus liabilities, right? Now, owner gets 10,000 from the business. 10,000 cash decreases. 10,000 assets decrease and equity decreases too. Yeah, because it's a drawing. It's a drawing. Owner gets 10,000 from the business for his personal use. It's a drawing. Cash decreases in the business and at the same time equity also decreases, but no change in liabilities. They are asking transaction that decreases assets and liabilities. So no change in liabilities. Second, business received 7,000 from a debtor. The business receives 7,000 from a debtor. Just like the previous question, 20th question. Getting cash from a debtor decreases the debtors and increases the cash. 7,000 cash increases and 7,000 debtors decreases. It's only a change in assets, no change in liabilities. Now, business purchases a stock of goods of 8,000 on credit. That is the third one. The business purchases a stock of goods 8,000. Purchasing goods, new stocks come into the business, that increases the asset. Which asset? The asset of stock, of course. The asset of stock is increased, but asset of stock is increased. How much? 8,000. 8,000 on credit. On credit means liability also increases. It doesn't decrease liabilities. It increases. It increases liabilities, right? It doesn't decrease. We have to find the transaction which decreases. So obviously, next transaction must be the answer, right? Or the business pays 5,000 to a creditor in cash, of course. Pays. Cash goes out. Cash goes out. So cash decreases. 5,000. Creditor also decreases. Creditor is a liability. There we go. Decrease, decrease. Assets and liabilities. That's what they are asking, right? Transaction that decreases assets and liabilities. Bingo. Next. A business purchases furniture of 25,000. Oh no, 250,000 from motor furnitures in cash for the office. Not for the reselling, not to resell. Okay, this business is not a furniture reselling business, not a furniture salesman. It's maybe a grocery, maybe a supermarket. So purchasing furniture from motor furniture in cash for the office use. So here we have to underline two main things. Furniture is purchased for office use, okay, and for cash. Yeah. Which means, guys, it's not a purchase. Wait, it is a purchase, but it's not a purchase of goods. So I wanted to say, that's what I meant to say. That's what I meant. It's not a purchase, means it's not a purchase of goods. Only purchasing of goods go to the purchaser's account. Only purchasing of goods go to the purchaser's account. Got it? So this goes to the furniture account because it's a purchasing of a non-current asset, furniture account. And it's for cash. The cash goes down. Cash credit. Purchasing account debit, wrong. Purchases account debit, wrong. Cash credit. Purchases account debit, wrong. Furniture account debit, correct. Cash account credit, correct. There we go. That is the answer. This is the answer. Furniture account debit, cash account credit. Next question. What do we have here? We have to answer question number 23 and 24 using the following information. Information, okay? This is the question instruction. Answer questions 23 and 24 using the information, following information. Transactions occurred in a business, okay? Okay. Purchases on credit, sales in cash, payment to a creditor, purchase of a computer on credit to the office. Okay, four transactions. Right, let's take the question now. Let's take things slowly. 23rd question. This one. The transaction that the paying voucher is used as the source document is paying voucher. Voucher is used. Transaction that the paying voucher is used. Okay. Paying voucher. That is a source document. For what do you use that source document? Paying voucher. You use the paying voucher to mention about a cash payment. To record a cash payment, you use the paying voucher. And from the bills, from the source documents, the voucher is specifically used for payments, paying voucher. Now, for what transaction you need to pay or to make a payment? Purchasing on credit, you don't make a payment there. It's a credit purchase. Purchasing on credit. Sales in cash, you don't make a payment there. No cash, do not go out. Cash coming in because you're selling goods and getting cash coming in. No payment there. Sales in cash. Payment to a creditor. Okay. See. Easy, right? Because the last one also, purchasing of a computer on credit. That is also on credit. No cash involved. Paying voucher is raised, or a paying voucher is issued with the seal, paid seal. A paying voucher is issued for a cash payment. Next one. Next one, this one. What is the prime entry book that is not used? Oh, that is not used. Not used. Not used to record. Not used. To record the about transactions A, B, C, and D. Okay. Let's mark the prime entry books. Prime entry books to record these transactions. The prime entry books which you must use these transactions. Purchasing on credit is recorded in the purchaser's journal. Sales in cash is recorded where? No, you tell me. I have been saying the answers all along for all the questions. And what? You have been listening to me. Now you do it. You do it. You do it. At least once. What? I'm asking, sales in cash is recorded in? Come on. Sales in cash. Cash book. Cash book. Cash book. Because selling goods and getting cash. So cash coming in. Cash book debit. Prime entry book, yeah. They're asking for the prime entry book, which is not used. Not used. Payment to a creditor, that is also cash book. That is also cash book. Purchase of a computer on credit to the office. Purchase of a computer. Purchase of a computer on credit. On credit. Okay, on credit. General journal. General journal. Because you are purchasing not goods. If you purchase goods, okay, that goes to the purchaser's journal. Purchasing goods only on credit. Purchasing goods. Only purchasing goods. This is a purchasing of a computer on credit. It goes to the general journal, okay? Which prime entry book is not used? Sales journal. Purchaser's journal is here. Cash book is here. General journal is here. Sales journal is not used. Next question. Select the transaction that double entry is recorded in 2 prime entry books. Oof. Okay. The transaction that goes to 2 prime entry books. The double entry goes to 2 prime entry books. How come? Double entries go to ledgers now. Oh. How come prime entry books වලට යන්නේ කොහොමද? Prime entry books also act as ledgers. There are 2 prime entry books which act as ledgers: cash book and bank book. Bank account. Cash book and bank account. And petty cash book is also a prime entry book. Prime entry book that acts as a ledger account too. That acts as a ledger account too. So petty cash book, bank book means bank account, and cash book. Those are the prime entry books which act as ledger accounts. So transaction that goes double entry, both entries go to prime entry book. Receiving a check of 15,000 from a debtor. What is the double entry of this one? What's the double entry of this one? Receiving a check. Receiving a check, coming a check, you know. If the check came directly to the bank, I mean, if the check was deposited in the bank account debit, but debtor's account credit. So debtor's accounts are not prime entry books. That means both double entry does not go to prime books. Only one goes to a prime. This is the prime book, bank. Okay. So you can't take that. Receiving 3,600 to reimburse the petty cash interest. Okay. Receiving 3,600 to reimburse the petty cash interest. What are the 3 prime entry books I told you about? Prime entry books which act as ledger accounts: cash book, bank book, petty cash book. Cash book, bank book, petty cash book. So in this transaction, receiving 3,600 from the main cashier. If I am the petty cashier, I should take the money, my petty cash float, cash, money, to restore, to refill my petty cash float. I should take the cash from whom? From the main cashier. So main cashier gives 3,600 to petty cashier. That's me. Reimburse the petty cash interest. Okay. The double entry is cash book, credit, petty cash book, debit. I'm going to erase this one, okay? Petty cash book, debit, cash book, credit. Both are prime entry books, right? Let's see the next. Purchasing a motor vehicle of 2.5 million to the business in cash. Then purchasing a motor vehicle. Okay, motor vehicle account debit, cash goes down, so cash credit. Motor vehicle account is not a prime entry book. Double entry, both do not go to prime books. Purchasing a motor vehicle. Paying owner's private insurance premium of 10,000 from the money in the bill. That's a drawing. So this is the answer. This is the answer. Next one. The balance of the petty cash book of Rehan's business was rupees 500 at 31st of March 2023. That is the end of an accounting period, or maybe a month. Yeah, that is the end of a month. 31st March 2023. There was a balance, money, cash remaining with the petty cash here in the interest. Okay, not spent, balance remaining 500. So if this is the petty cash box, I always draw this so the students are very easy. Students, you can understand very easily. If this is the petty cash box, now inside this 500 is remaining, the balance remaining 500. Okay, got it. Balance petty cash book 500, 31st. This is the 31st, end of the month. Okay, amount of 4,500 was received for the reimbursement of petty cash interest on 1st. So 1st April, the next day, the 1st April, First April, 1st April. This is 31st March. This is 31st March. And the next day, 1st April, you got how much? You got coming in, cash coming into the business. That is the reimbursement, 4,500 coming in 1st April. Okay, 4,500. That is the reimbursement received for the reimbursement of petty cash interest on 1st April. Balance of petty cash book was rupees 400 as at 30th. Oh my god, 30th 4th. April month also ended now. And petty cash book balance was 400. After this month, when the April month 2 came to an end, at the end of April, April 31st, April, how much remaining? There was balance of petty cash book 400 was remaining. Okay, 400 was here remaining. This was balance on March, no? Balance on March 31st. So this is the March 31st balance, right? And April 31st, 400. April 31st. Okay. What are they asking? What are they asking? Let's look at what they're asking first. March balance 500, April balance 400 at the end of April. As at 30th April 2020, the amount received for the reimbursement. The amount received for the reimbursement of petty cash interest 1st May. Oh my god. It's an easy question. Why did we go so far? If the balance of petty cash book Rehan's business was 500, 31st March, this is 31st March. This is 31st March, okay? 31st March. And you got this much, 4,500. $4,500 should be here. And you got 4,500 here. What is the interest? 500 plus 4,500. It's 5,000. Interest is 5,000. This is the interest. If the interest is 5,000 at the end of April, you already had 400 left. To that, you should receive from the main cashier 400 left. So you should receive 4,600. 4,600 as the reimbursement to make the interest. To make the interest. Oh no. To make the interest 5,000. Where's the answer, huh? Reimbursement of petty cash interest 1st May 4,600. Yeah, that's it. Next, the following is the double entry relevant to a certain transaction recorded in the ledger of Shakti business. Following is the double entry. Double entry means the double entry. Yeah, double entry means the double entry. Yeah, what else I can say? Double entry is a double entry. Debit entry and credit entry. Bank debit 12,000. Sales credit 12,000. Select the transaction relevant to the above double entry. Okay. Following is the double entry relevant to a certain transaction recorded. Shakti business. Must be a hardware, no? Hardware. Shakti hardwares. Shakti business. Bank account is debited. Sales account is credited, which means bank increased. So asset increase, then only you debit the bank account. Cash coming into the bank. Bank increase. Bank money increase. Cash at bank. And how did the cash at bank increase? Because you sold something. Sales account credit. Sales account also credit. What is the transaction relevant to the above double entry? Depositing the check of 12,000 received from a debtor? No. It's not a debtor here. It's a sales account. It's a sales account that we have here, right? It's not a debtor's account. It's not a debtor's account. And transferring a check of 12,000 received for sales in cash to super. That might be the answer. That might be the answer. Transferring a check of 12,000 received for sales. You received a check. You transferred it to the bank directly. So the bank got that. I mean, the 12,000 was credited to the bank. Deposited in the bank. Received for sales. So sales account is credit. Depositing the check of 12,000 received for sales in cash in the bank. Yeah, depositing the check of 12,000 received for sales in cash in the bank at the same time. This is the answer, yeah. You know, as the sales, the goods were sold, when the sales happened, the cash was directly deposited in the bank account, which means you didn't get the cash from the customer to your hand. You told the customer, okay, transfer the money to my bank account, make online transfer. Here are your goods. Depositing the check of 12,000 received for sales in cash in the bank at the same time. Or maybe the check was directly deposited in the bank. Okay? That's it. Next one, the balance of bank account. The balance of bank account of Satsara's business was 12,500. This is from bank reconciliation, isn't it? Statement and balance and everything is mentioned. So this is from bank reconciliation. All the way up to bank reconciliation. Balance of bank account, Satsara's business, was 12,500. Okay, 12,500. Balance of the bank account of the business, 31st March 2023. On the same date, the bank statement balance was 9,000. In the bank statement, which was received by the bank, from the bank, the bank statement, when you open the bank statement, it was 9,000, the closing balance. That is where you need a bank, that is where you need to prepare a bank reconciliation. When the bank account of the business, the T account of the business, or the, as some children say, bank book of the business, that balance of the bank book and the balance of the bank statement, when those who do not tally, you have to do what do you have to do? Prepare the bank reconciliation statement. On the same date, the bank statement balance was 9,000. So our bank account balance is higher. The business bank account balance is higher, but the bank statement shows a lower balance. What has happened there? Let's see. Only one transaction affected for this change. Only one transaction affected for this change. That transaction could be amount of 3,500. Let's take the difference first. Bank balance, $12,500. Bank account balance, right? Bank account balance. Then bank statement balance, $9,000. Difference 3,500. Yeah. Our bank account balance is higher. Bank statement is showing a lower balance. Maybe the bank has, embezzled money out of our bank account, huh? No. That is stupid. You must find the reason for it. Only one transaction affected for this change. The reason. Amount of 3,500 sent directly to bank account. The amount of 3,500 sent directly to bank account of the business by data. Amount of 3,500 sent directly to the bank account. Then directly this 3,500 is going to the bank account then it is getting added to this, then this should be higher. This should be higher, but that is not the case. It is lower. So that is not the answer. The dividend income of 3,500 sent directly to the bank account of the business. Dividend income 3,500 sent directly to the bank account, which means it's going directly to the bank statement, and the bank statement balance again should be higher, but that's not the case. Dividend income, see, 3,500 sent directly to the bank without entering to our business bank account, then the bank statement should be higher. No, it's not the case. The check of 3,500 issued to a creditor by the business and not presented to the bank. The check of 3,500 issued to a creditor by the business, then check of then the check is issued to a creditor. Okay, see, check of 3,500 issued to a creditor, issued by us, which means we have entered it to our bank account, and because it's an issued check, our bank account balance should be lower because we issue a check to a creditor. No, we get the checkbook, we take a check and we write the check to a creditor, we give the check and we credit the bank account, so our bank account balance should be lower. Again, that's not the case. Again, that's not the case. Obviously, the last answer. What is it? The electricity bill of 3,500 paid by the bank on standing order. Standing order. Let's take this one. Electricity bill of 3,500 paid by the bank. It is paid by the bank, so it has been recorded by the bank, and it's a payment, so the payment decreases our bank balance, and the statement balance is lower, 3,500, than business bank account balance. 3,500, see? That's the answer, right? Fourth one is the answer. Fourth answer. Bingo. 29th. Select the transaction that is debited to the bank account when adjusting the balance of the bank of the business after receiving the bank statement. Select the transaction that is debited to the bank account. Bank account. Debited. Which means, children, our bank account. They're asking what transaction should be debited. What transaction should be debited? To the debit side, let's see. Electricity charges of 2,500 paid by the bank on standing order. Electricity charges is a charge paid by the bank on standing order. So it is paid. Who paid it? Bank paid it. We don't know that they paid the electricity bill of the business because it's a standing order. It's a standing order. Electricity charges 2,500 paid by the bank. You have to know about standing orders, right? You have to know. Then it's a payment, it goes to the credit side. First one goes to the credit side. When we adjust our bank account. This electricity charge goes to the credit side. Next, can you see this? Checkbook fee of 1,500 charged by the bank. That is also a charge that also goes to the credit side. It's a bank charges transaction. Goes to the credit side. They are asking transaction that is debited. That's what I'm going to find. The transaction debited to the bank account. Third one, amount of 5,000 deposited directly in the bank by a debtor. Amount of 5,000 deposited directly, cash coming in directly to our bank account. We don't know. Debtor has online transferred or put a deposit to our bank account. When the statement comes, we look at the statement and there's a 5,000. That guy, Mr. X, has deposited into our bank account. Money coming in directly to the bank. We don't know. We are in the business. But when the statement comes, after receiving the statement, see, we debit it to our bank account. Third one is the debit. Yep, so debiting transaction should be this one. Again, service charges, it's a credit one. Okay. 30th, to calculate the results of the economical activities done in a certain period, not-for-profit organizations prepare. That is theory knowledge, guys. That is theory knowledge, huh? This is actually like a practical analysis. You can think these transactions. You can think them out practically. These transactions. But next question is theory. Yeah, we selected the correct answer, right? Yeah. This is theory. Calculate the results. To calculate the results of the economical activities. What are they talking about? Economical activities. They are talking about the profit or loss. Operational results. These are, like synonyms. Operational results. You can say operational results, or you can say economical activity, result of economical activities, or you can say profit or loss. See, they are giving you different terms to check your understanding. Results of economical activities means the profit or loss. Is calculated in a not-for-profit organization in the receipts and payments account, no. Statement of finance, no. Trading and profit or loss, no. Income and expenditure account. Bingo. In your syllabus, it is known as the income statement. Income statement, but in the paper it says income and expenditure account. That is sometimes a confusing thing. But the teachers, when the teachers teach you, they must say that this income statement is also known as the income and expenditure account. Income and expenditure account, yeah? Yeah. This is another name for the income statement. So, it is the income statement actually. Yeah. Yeah. Income and expenditure account is the word given in the paper. Okay, the answer is that. What is the transaction that is recorded in the receipts and payments account but not included in the income and expenditure account? Again, income and expenditure account. See the income statement. This is the income statement. Income statement. In a sports society, it's a sports, they're asking about a sports society. Sports society means a sports club, football club, karate club, a cricket club. Not included in the income and expenditure, but is recorded in receipts and payments. Must be a payment for a non-current asset purchase. Purchasing sports equipments. That is the answer. But let's check the next. Receiving membership fee. It must be recorded in the income and expenditure because it's income. Receiving of membership fee. Selling newspapers. It's an expense. Must be recorded in the income and expenditure account or income statement. Selling newspapers. Depreciation of sports equipment. It is recorded in the income and expenditure account because depreciation is a expense. Sports equipment cost is an asset. It doesn't go to the income and expenditure account or income statement. That is the answer. Yuck. Yeah, so these questions are from non-profit organizations, not for profit organizations, clubs and societies. Receipts and payments account, income statement. Here they say income and expenditure account, which is the income statement. Same thing, different name. All right, guys. So with the 31st, we are going to end this chapter. We are going to end this video. This is the 2022 O-level paper, the latest paper that you can get your hands on, the most recent paper. And the exam was done in 2023, this year, right? Yeah. First paper, MCQs. Up to 31st we have done. So the next, the rest of the questions until 40 we'll be doing in the next video. Yeah, the last 10 questions. For most guys, for most of you, the last 10 is the the difficult part because the questions are from financial statements. Not that difficult. We'll work it out. So until I see you again, have fun and good luck.
To watch these important lessons, subscribe to DP Education's YouTube channel right now. Click on the bell icon to stay updated on the latest lessons. Sri Lanka's largest free online school, DP Education.